What's the easiest way to determine value? I'm Tim Diesel, I'm a commercial real estate consultant, and I'm here to help you determine value quickly today. All right, so I talked about quick ways to figure out what your cap rate would be or your return on investment of the property. And we went through those a little bit. Now, let's make no mistake about it. It depends on what you're looking for, okay? If you've got just a bunch of cash and you just want a safe, solid return, and what you're trying to do is buy triple net leases, you've got a way different strategy. You don't care, you're just gonna let it ride for 10 years or something like that. Now, if you're a rookie investor and you're trying to generate some cash and build a portfolio, that's a little bit different, right? So you're determining value a little bit differently, actually, because you need to figure out what cash is coming in and what you can do to increase the property. Now, depending on the project, see, some projects, they're really not a total value add in terms of actual physical construction. See, a lot of them are just moving some of the numbers around. Maybe the rents are too low. You got to get rid of some problem tenants. Maybe you just have to do some changes to the laundry facility or something like that. It doesn't mean every property you've got to add units and take this and tear down walls. It just kind of depends on the project. So the way to determine value is what you're looking for. A lot of times I'll be looking for cash flow properties, but when I look at something, the cash flow may not be great, but long term, it's got a really strong tenant in there. And that becomes attractive. And you kind of shift things a little bit. So you really want to see what you're trying to do. So if you're working a job and you can't stand it and you need cash flow right away, that's one method, right? And the reason I'll say that, I'll give you guys an example. If you're going to buy property, let's say in Kansas City somewhere, well, the cap rates, you might find something for like 12%. But what are the odds of it jumping up overnight where you have a lower cap rate? See, this is very important. The lower your cap rate is, the easier it is to raise that value. So if you're in Los Angeles and you've got a 4.5 cap, maybe that's the average out there, well, getting an increase is a little bit easier. And I'll make another video explaining that a little bit more. So if you have a really high cap rate, you really got to focus on that cash flow immediately. So the minute you close, you got to get that cash flow coming in. And do not fall for whatever these brokers are selling you. I don't care if they're CCIM and they're trained professionals and they're talking about projected value. That's worthless. That really is. I don't care if they tell you that or not. Because a bank is not going to look at that. They're going to look at what money has been coming in. And they're not going to look at what's been happening. No, you can't really determine it that way. So you really want to focus on what you can do, what can be generated now. So when you close, you need to make money immediately. And if you're going to be doing some renovations where you're going to be, I don't know, if it's a 20-unit building and you're getting rid of 3 or 4 tenants at a time to renovate and do all this stuff, you need to factor that into your numbers, and most of you do. You do a great job at it. But at the same time, really go back to what area are you investing in? So a lot of times what's happening, I'm noticing this, somebody will say, well, I only want to buy $1 million in property or $1.5 million. That is not the way to do it. Stop that immediately. Figure out a different method, because if you're looking at $2 million, well, if you're looking at $2 million in Boston, it's going to buy you something totally different than $2 million in Montana. So you really want to figure out your market, and then you want to figure out what can be bought there. So don't price yourself out immediately. It can be done in your backyard. You just need to do a little bit of due diligence on the property maybe, or the tenants, or whatever the case is. You got to remember, some people have owned these properties for 20 years, 25 years. They're over it. They've made their money. They are not opposed to getting a little bit of cash through seller financing. The problem is they're not presented properly. If you do that, there's very little reason they would tell you no. Because somebody who's owned their property for 20 years, most of the time they don't need all their cash at once. It doesn't happen that way. I haven't seen that too often. Somebody owned it for 3 or 4 years, it's more likely. So figure out what area you're in, and then figure out what you're looking for. So if you're looking for more cash, you're not really looking for the price of the property. And I want to make another point. Let's say A person's selling the property for $900,000 and they say it's worth $1.2 million. Well, I would much rather pay $1.2 million and keep all that money at closing, at cash back of some sort. And I'll show you guys some creative ways I do that. I would much rather overpay and put no money out of my pocket. Why would I want to pay all cash, get a better deal? That doesn't make sense because I can only do like one of those deals. But if you do it the other way, where you have no money into the deal, even if you have a lot of debt, we can do a lot of those deals. So, but it depends on where you're doing it. See, if you're doing that deal in San Francisco, you're looking at $4 or $5 million. But that may not be right. It may not be conducive to what you're trying to do. But if you're looking for cash flow deals and you need money today, that can likely happen in Oklahoma. See what I'm saying? So break that down a little more to where you are and what you're looking for. I hope this video was helpful. If you guys have any more questions, definitely let me know. I'm here to help you out. Thank you.